Hello, everyone. Today on the final bar, I'm talking to Matt Tuttle from Tuttle Capital Management. We'll talk about this overall market environment. Yesterday's full-on distribution day leads into today, which is basically a choppy mess, is how I would, that's the official technical analyst term to describe this market environment. So many competing movements, so many competing themes. We've talked many times about how charts really show you the emotional reaction of investors. We're seeing that elevated. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques to better quantify investor behavior, better get our head around the emotional reaction of investors, and focus as much as possible on connecting the short-term movements, the flickering ticks of the market with the long-term trends. And it's difficult in an environment like this because you have a lot of sudden movements. Earlier today, late morning Eastern time, you have a push to the upside on some news related to events in Ukraine, quickly giving a lot of those gains back as the S&P finished the day really at the lower end of the day. So, you know, my comment to someone, I was speaking to someone on the phone as the market started rallying just after lunchtime Eastern today, and my comment was like, how much really has anything changed? And the answer is not much. These are minor headlines, but everything's magnified. And we were talking about how the current market feels like if you took the market 20 years ago and turned it into a triple leveraged version of itself. This is how the current market environment sort of feels to me and others. We have great guests on the show. I'm excited to talk to Matt Tuttle, who always does a great job of trying to simplify and make sense of what's happening around us as investors. Elsewhere on StockCharts TV this week, tomorrow on this show, the 9th, we have Jonathan Krinsky from BTIG. Next week on the 15th, we have Samantha Leduc from Leduc Trading. She's more of a strategist, more of a macroeconomist, so always interested to get her take, especially given Fed meeting in March. Also, today is our latest episode of The Pitch. I'm really excited about this episode because in celebration of Women's History Month, we have an all-women panel featured on The Pitch. We have Erin Swenlin from Decision Point talking to Mary Ellen McGonigal, Mish Schneider, and Danielle Shea. Should be a lot of fun and three really knowledgeable, really four, including Erin, very knowledgeable experts giving their take on the market environment. Go to stockcharts.com/thepitch for more information on that upcoming episode. Let's get to our market recap. And we'll talk about the overall movement. As I mentioned, this is a choppy environment. There are a lot of competing narratives and a lot of elevated volatility. So at the end of the day, it's focusing on the message of the markets. And I was told early in my career, pay less attention to what's happening. If you're a long-term investor, pay less attention to what's happening intraday and focus on the closes. Focus on what material movement has occurred in the market from one day's close to the next. That can help sort of get away from some of the noise and some of the emotion of the markets and focus on where the S&P or whatever benchmark you're looking at actually progressed through the course of the days and subsequent days. So the S&P closing down around 4170. So even though we spent much of the day above the zero line, above 4200, which was yesterday's close, we went below by about 30 points today. The NASDAQ composite down as well, but not quite as much as the S&P itself. Mid caps and small caps actually finished today okay, but a choppy environment. Small caps probably the best of the bunch, sort of moving higher into the close. But overall, it was a day of distribution at the end of the day for stocks. Interest rates progressing higher through the course of the day. The 10-year yield went higher, up around 187 at the close. Bond prices obviously coming lower. The dollar index essentially flat from yesterday. Gold prices are accelerating to the upside, same with silver. So the precious metals trade, and it's interesting, I posted a chart about this on social media earlier today, and it's sort of gold is finally doing what you might expect as a safe haven, as an inflation against, or a hedge against inflation. It's kind of where you would expect gold to shine, and it really hasn't been, right? You've had those potential issues. You've had uncertainty for equities. You've had inflationary concerns that are growing, but gold really hasn't, driven to the upside until recently. You're seeing the GLD push higher through the course of the day yesterday, continuing to go higher through the course of the day today. Commodities as a whole higher, along with oil prices and energy stocks as well. Finishing off cryptocurrencies, a lot of volatility in this space as always. Bitcoin about 2% higher from yesterday, and Ether just above 3% from where it was at yesterday's close. Let's look at a chart of the S&P 500. A little later in the show, you're going to see me zoom out a little bit because what's happened now is we have had a confirmed close below 4,200. Now, that's an important level we've been talking about for quite some time, mainly because that's the first Fibonacci support level. If you take the low from September of 2020 and go to the high in January of 2022, you'll find 4,200 is a pretty key level. So here we've drawn the chart back a little bit. We have the low from September of 2020, which is around 3,200. We have the high from January of this year, which is around 4,800. If you go 38.2% of the way down, you're right at 4,200. That's that green shaded area we've been highlighted. So what's so interesting is on that initial sell-off in 2022 in January, we came just above 4,200 to around 4,220. We bounced higher to just below 4,600 and now rotated lower. We've bounced off the green shaded area again. Today, we're closing below it after yesterday closing right at that level. I've promised that if we start closing below 4,200, you will hear me take a much more cautious tone and talk about downside objectives, and I think we're there. Given the deterioration that we've seen, not just this week, but for weeks and arguably months, as the fact that the momentum picture has got less and less encouraging, less and less supportive of bullish price action, and more confirming negative price action, I think we have to start looking at downside objectives. Now, if you continue that Fibonacci relationship, take September 2020 to January 2022, after 4,200, you have the next support level around 4,000, around 4,010, which would be a 50% retracement of that move. 61.8% is around 3,800. It's just above there at 3,820. That would take us back to where we were in January, February, March of 2021. That would be a pretty significant drop, as you could guess, 24, 25% or so off of the highs there. And to be honest with you, I think that would be my next downside objective. We've talked about some downside objectives in the 37 to 3,800 range. I think given the breakdown that we've seen, that's a valid downside target for the S&P, which would suggest that you see further breakdowns in names like Netflix and Meta platforms, which have struggled to hold support after gapping lower. That would mean most likely charts like Apple, which have been relatively immune to deterioration, other parts of tech and consumer start to struggle as well, along with some of these other spaces that we've seen. What's interesting is today's action, while yesterday was a little more of a defensive feel to the tape with the exception of energy, which continues to be at the top, today was a little more with offense on the top, and consumer discretionary communication services, even technology were at the top of the leaderboard earlier today. Settled down quite a bit, obviously, as the market rolled over going into the close. But overall, the bottom of the list today are some of the more defensive sectors: consumer staples, healthcare, utilities, real estate. The four from at the bottom of the leaderboard today. So sort of energy and some offense over some of the defensive sectors. Some of the cyclicals like industrials and materials, end of the day, sort of right in the middle. You know, we've talked about that long-term strength in the energy sector. I'm excited to talk to Matt Tuttle a little bit because I know we're going to go there when we talk about some of the emerging strength in the S&P and elsewhere in the markets. So I want to focus just a little bit on a couple other charts before we take a break. The breadth conditions are concerning, and when I think about this market environment, it's about the price action, number one. And one of my mentors, Ralph Akinpour, always said, if you know nothing else about the markets, look at a chart of the S&P 500. That can tell you much of what you need to know about market conditions. I see that as breaking down. So how can we confirm that or validate that or invalidate that by looking at some other metrics? Breadth indicators are a really good way of understanding the stocks that comprise those indexes. The S&P is breaking down. What about the 500 stocks that are the members of the S&P 500? What about mid-cap stocks and small-cap stocks? How are they faring relative to the major benchmarks? Here we have the cumulative advanced decline lines for the New York Stock Exchange on top, then the S&P 500 large cap, S&P mid cap, and then S&P small cap at the bottom. So a couple things to notice here. Number one, starting at the top, you can see how the common stock only advanced decline. This is looking at all the listings on the New York Stock Exchange that are common stocks, so no closed-end funds or anything like that, making a new swing low, and that's actually as of yesterday's close. This isn't updated for today's close just yet. So given the deterioration we saw going into today's close, I would imagine that that line downticks a little bit further, which means while the S&P has been attempting to hold 4,200, attempting to hold support, which arguably failed today, you can see some of these breadth measures have already been breaking down, right? So the signs of deterioration have been on some of these other charts. It's just now being confirmed or being validated with the S&P breaking a support level. Also, look at the small cap breadth overall, which has been fairly negative as well. The outlier, the one that has been holding up the most, is large cap. So if you look at these three, the large cap in orange, the mid cap just below there, and the small cap, you can see that it's been large, then mid, then small in terms of relative performance, right? The weakest performance in the smallest names in the index, the strongest breadth is in the large caps. Given the fact that the S&P went lower today, I would guess that this line finally breaks below its December low as we update these charts here, processing some of the closing data going into the weekend. Going into the remainder of this week. I'd also point, just to finish off our market recap, breadth also deteriorating on other measures. The bullish percent index remains in a bearish configuration. Percent of stocks above key moving averages remains below 50%, with now less than 30% of S&P members above their 50-day moving average. You would need to see that improve to really get a sense of a bullish emergence from this deterioration in stock prices. We need to take a quick commercial break. We'll be back with today's guest, Matt Tuttle. We'll see you in a minute. Final bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts, using the technical analysis toolkit to better understand market dynamics. A couple of quick comments before we get to today's guest, Matt Tuttle. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and we'd love to feature one of your questions in our next mailbag segment, which will be later this week. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment later this week. Also, go to StockChartsTV.com. That is our on-demand platform. All of our great content, special guests, interviews, and also special events like the pitch, Larry Williams market outlook from last week, so much more, all for free on demand. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Matthew Tuttle. Matt's the co-founder and portfolio manager at Tuttle Capital Management, creator of a series of ETFs, which you probably know of, a SPAC ETF, a short innovation ETF, and many more. Matthew, welcome back to the show. It's good to see you.
Hey, thanks for having me. Good to see you too.
So we're going to start looking at the Ark Innovation ETF ARKK. Clearly, there's been a deterioration in price over time in a lot of areas of the market. But as a technical analyst, I'm seeing a downtrend. How are you making sense of this market here?
Yeah, so I've always, one of my favorite sayings is trade based on what you see, not based on what you think. And don't remember whether I made that up or heard it from someone, but basically meaning be in what's working and don't be in what isn't. And the beauty of technical analysis and stock charts is sometimes it is extremely obvious what's not working. And this is one of those times. So, this fund has just collapsed, since, really since November, but even going back to February of last year. And, it's a fund that's made up of speculative technology stocks, which, peaked out in February of last year, and just not the right type of environment, rising interest rates, higher inflation, throw in what's going on in Ukraine, just not the right type of environment for these types of stocks.
I love your comments. Trade on what you see, and really the technical toolkit. As you know, it's driven by what trends are actually emerging, and it's hard by any definition to see this chart as anything but a fairly consistently confirmed downtrend. Now, flip that chart over in a lot of ways, and you have the energy sector. How are you interpreting this here?
So here is what's working. And and obviously we know why. I mean, we've got the crisis in Ukraine, but even before that was going on, you had energy stocks zooming up. I mean, they've
Mm,
been zooming up really all year. If you look at it, at the beginning of the year is when XLE broke through the 50-day, and just, besides a, little couple little pauses, really has not looked back. One of the things, though, especially after today and kind of what we saw intraday with energy stocks, I would be a little bit concerned that these are overextended.
mm.
So, whereas maybe in the past you could kind of throw a dart at pick your favorite energy stock and it would go up, now I think you got to be a little bit more selective. We cut a little bit of our energy exposure today in our FOMO ETF. We had about 28% energy exposure, and we cut it, by about 10% to about 18%. And, so we still think this is the area that's working. It just, it maybe needs a little bit of a break here. Long term, though, we still love energy stocks.
So, given it's two great examples, really telling the story of technical analysis. So, thank you for picking two really good examples for us. When you look at the S&P right now, just breaking below 4,200 now, closing below there for the first time in quite some time. So, the market, overall taking sort of a risk-off feel. If energy is overextended, where do you hide out in this sort of environment, or from your experience, where do you look opportunistically, given the fact that there's so much uncertainty underlying the market here?
So this is going to be really exciting. Cash. You know, one of my other favorite sayings, and I know I didn't make this up, is nothing good happens below the 200-day moving average.
Mm,
So, all the major indices are below their 200-day moving average. You've seen that they've had little bitty bounces, and then they sell right back off.
yeah.
What you've also seen is stocks that were like the leaders, Fortinet, Expedia, companies like that looked really strong. And then all of a sudden you turn around, they're down like 11% and they're below their 200-day moving average. So, really, the only thing I trust right now, outside of energy, outside of gold, outside of some materials and
Sure.
some metals, is cash.
I feel like at times cash has been a bad word. Maybe it's not the case anymore, right? The idea of not losing money at this point may be a compelling option for many. Listen, Matt Tuttle, it's a
There's going to
pleasure.
be great opportunities from this, just not today. So have some cash and be ready.
I like that. Be ready for the next opportunity that comes up. Matt, it's great to see you. Thanks for coming on the show. Pleasure to have you on as always. Congrats on your successes and keep it up. We'll talk to you again soon.
All right. Thanks.
That's Matt Tuttle. Matt's a portfolio manager at Tuttle Capital Management, creator of some ETFs you probably know, like FOMO, the fear of missing out ETF, SARK, the short innovation ETF, and a number of other ones. I like if you when I was talking to him, just the two charts. I ask all of my guests, give us two or three charts that you'd like to talk about, and it's fascinating to me to see what charts they select. And I love the simplicity of the two charts that Matt shared with us. Number one, here's a chart going down. Step two, here's a chart going up. And what's so funny is so many times we try to get way more complicated than that. At the end of the day, a lot of times that's what we need to ride out some of these uncertain times. Great take there from Matt Tuttle, Tuttle Capital Management. Let's continue on with our next segment, the Final Bar Mailbag. As a reminder, all of our questions come from you. Our email is thefinalbar@stockcharts.com. Anytime a question comes up, shoot it our way, and we'll answer your questions hopefully in the next episode. Question number one. Many of you at StockCharts.com emphasize ratio charts of stocks to broader market or its sector or industry, or that particular industry versus sector versus broader market. How would you consider classical technical events such as RSI or MACD or moving averages in comparison to ratio charts in terms of importance weight? That is a really, really good question. And when you talk about performance, you talk about what you're calling ratio charts. I would call those relative charts. Relative analysis, relative strength is a common technique that I use certainly in my time as an institutional investor, because essentially your goal was to outperform a passive product, outperform the benchmarks. So you did as much as you could to try to understand how you're performing relative to the benchmarks. I think Grayson and Gaddis Rose do better than anyone in terms of setting up charts that show these relative relationships. This is a chart style that Gaddis Rose shared with me when I was just getting started with StockCharts and was trying to use the product more effectively. And it shows the stock versus the broad market of equities, its sector technology versus the broad benchmark, the group within the sector, so computer hardware within technology, and then Apple versus hardware. So all four of these show you those different relationships that you implied. But you'll also notice on his charts, he also has things like on balance volume, which shows institutional participation or implies institutional participation. Chaikin money flow, which is another measure of really institutional participation on the upsides and the downsides, a way of incorporating volume into your analysis. You'll find on my charts, I use usually price, RSI, and the relative strength. And there's a reason why Gaddis and Grayson and myself and others incorporate those traditional technical indicators, because I would argue those help to confirm what you're seeing with price. Price does one thing. I look at those indicators to confirm what you're seeing with price. Are you seeing validation of the price movement, a breakout or a breakdown in the form of volume or some volume derivative or a trend following tool like MACD? So I would argue at the end of the day, those certainly have importance. In terms of how important they are, that is really up to you and your individual approach. For me, the relative strength, the ratio chart, as you talk about it, is the most important, because my goal is to be in stocks that are outperforming. It might be different for you, but I would make sure you have a good way of answering that question for your own process. Question number 2, do you ever use the point and figure charts? I find sharp charts can be confusing with two or so many indicators. After looking at sharp charts, I like to switch to the point and figure chart for confirmation of a trading decision. The point and figure charts are very clear and currently show we are in a downtrend. I think that's totally fair. And if at the top of stock charts, this is where you usually enter a symbol or a ticker. If you click on where it says sharp chart and change to gallery view and bring up just any chart, this will show you, I think, what stock charts really suggest would be a well-rounded way of understanding a stock like UNH. You have an intraday view to understand the short-term dynamics. You have a daily view giving you that sort of medium-term time frame, in my opinion. You have a weekly chart to look more at the longer-term trend, looking multiple years in history and understanding where this trend, where we've been leading up to the most recent view. And then it's the point and figure chart. And as Chip Anderson, our founder, was designing stock charts and working with John Murphy and Greg Morris and Martin Pring and others to really make the site an effective use of the technical toolkit, point and figure charts became an important part of that, of telling that story. So I certainly do. I rarely take the time to share those charts on the air, only because we have limited time and a 30-minute show every day. But if I had a limited time, we would probably have a lot more point and figure charts on there. And I think for that reason, they sort of strip out the noise. That is really the intention of a point and figure chart, is to get rid of the noise and really focus on the pure trend. Is the trend up or down? So we do talk on the show about bullish percent indexes, which are based on point and figure charts. I'd encourage you to check out Bruce Fraser's show, because he does a great job called Power Charting. He does a great job incorporating point and figure in his show every week. Next question. I was listening to one of your recent shows, and you mentioned that you like to scan for stocks making a new 3-month breakout. I've not had success trying to create such a scan. Can you help, please? I was also wondering if there's a way to get the percent of stocks in a silver cross or percent of stocks in a golden cross. So you cheated. You have 2 questions in one, but I'm going to indulge you and give you the answer to both of those. So I run a scan every week, and often a couple times a week, for my Market Misbehavior Premium members. And I'll show you there are a couple ways that you can actually do this. This is a new swing highs scan that I created. I probably should show you the scan. I was just showing you the results, which are fascinating. But let's actually look at how the scan is created. So as you're watching the show, if you pause it or rewind it, or if you're watching on demand, just hit pause and you can check it out. This is the syntax that I use, and I'll walk you through very quickly. What I'm basically trying to do is look for new 13-week highs. So I'm saying out of the last 13 weeks, I want to make sure today we're trading higher than the highest close over the last 13 weeks. So working with Bill Shelby, who's really our in-house expert in the scan engine, we came up with this argument. Weekly close is greater than last week's max. 13 is the look back period, and the closing date is what you're looking at. I'm also looking for market cap above 10 billion, traded on one of the major US stock exchanges, and it's not an ETF. I have a separate scan that I use to look for ETFs. If you reverse some of those arguments, you'll get the new swing low scan. That's going to show you within the last week what's trading higher than it has in the last 13 weeks on a closing basis, based on whenever you run that scan. Now, you also have to remember you can backdate this. So you can look as of yesterday's close. You can start a couple days prior. You can say as of last week what fit that criteria. So there's a lot of flexibility in the scanning engine to actually look for particular ideas. That is how I like to scan for stocks making new swing highs. You also mentioned stocks making, in a golden cross. Here's what you have to do. Actually search for the keyword golden cross. It's going to give you this page. This is where you search for symbols, and you can see all of these different indexes which track how many stocks are in a golden cross. Now, what we define as a golden cross is looking at the 50 and 200-day exponential moving averages. The 50 is above the 200-day. That is a bullish configuration, and that's what's going to pop up and show as a positive on the scan. We have it for a bunch of different sector indexes, different major benchmarks. I'd encourage you to look there. The golden cross, the silver cross, just do the same thing, just search for a different word. That's based on the work of Carl and Aaron Swenlin with Decision Point, do such a great job of creating a lot of custom breadth indicators like those. That is all the time we have for the mailbag. Keep your questions coming. I think we're going to do another mailbag segment on Thursday's show this week, and we'd love to answer your question on the air, so send them our way. We need to finish the show and go to the 3 in 3. 3 charts in 3 minutes. Let's hit on 3 of the top charts in the markets right now. Chart 1 is the S&P 500. We're going back to September of 2020. I have promised you, and I'm following through as suggested. I said when we get below 4,200, we get below that first Fibonacci level, I will then have to start talking about further downside potential. If I had to give a downside target for the S&P, it would be around 3,800. That's based on moving to the next Fibonacci support level. What I would encourage you, do I know that's going to happen? Of course not. And anyone that says they know for sure is lying to you or to themselves. There's no way of knowing for sure what's going to happen. But what we can do is think about what a market could do, and then think about how our portfolio, think about how our particular holdings or positions would fare in that environment. I would think about what the S&P going down another 10+% could do to your current positioning. What stops do you need to make sure are updated? And the market could turn tomorrow and rip up to 5,000 in the next couple of weeks. I say that's highly unlikely, but it's possible. So you might want to think about some different scenarios and where we might net out. But given the break below 4,200, I think that clears the way to further downside potential. Chart number 2 is further support. We talked about breadth deterioration. I'll also talk to you credit spreads are further confirming the deterioration. Here is an interesting chart. I'll just take a moment to explain it. We have the high yield OAS spread is at the top panel, and that's inverted. So this is basically telling you how much investors buying high yield debt are needing to get in terms of additional yield to justify buying risky debt given the uncertainty in the market. This chart going down visually means the spread is increasing, and widening spreads means more and more risky. You can see the spreads going down on this chart goes along with the VIX going lower on this chart, which is the VIX actually increasing. So increasing credit spreads, elevated volatility usually lines up with the S&P going down. That's why I have these charts plotted inversely, because you can see how closely they track the movement in the S&P 500. Those lines stop going lower, I will start telling you that conditions are not as bad as they are right now. But overall, this is a market in distribution mode. So what's working? I asked my guest, Matt Tuttle, today, did a great job explaining some of the things, materials, energy, obviously doing well. Some of those appear to be overextended. I don't disagree with his take on the energy space. I'm interested that one of the top performing groups today was not old energy, but what you might call new energy, renewable energy equipment. Charts like First Solar, Enphase, Plug Power, all up significantly today. Some of those up by 8 to 10%. First Solar, which we're highlighting here, obviously one of the solar names, back above its 50-day moving average for the first time since late November, and breaking above trend line resistance. These are charts that are starting to work after bullish momentum divergences. I like to be in charts that are working, charts where the trends are going higher. You're seeing that in that group. Folks, that's a wrap for this show, and thank you so much for joining us every weekday after the close for our show. Special thank you to Matt Tuttle from Tuttle Capital Management joining us today. For StockCharts.com, In Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.